Good morning. Thank you for joining us. You're all brave, brave souls at 8:30 in the morning to talk about GAP. So real quick, housekeeping. We are trying to record this session, so if you ask a question, say it really loud, especially if you're way in the back, so that I can make sure our panelists can hear it. And real quickly, how many of you know about what we're talking about today? And how many of you started implementing like what this is going to look like in your dealership? Great. Well, like I said, thank you for being here. I'm super excited to be on stage with these four guys. They're brilliant. They're full of information, and I feel like this is going to be a really good session. We have some things that we're going to cover, but if you have questions, just kind of raise your hand, and I'll point you out as they kind of finish talking about their topics. It's supposed to be interactive, so make sure you walk out of here with what you came in needing to know, okay? Steve, can I start with you and just introduce yourself real quick, and we'll kind of work our way down the line and get started?
Just introductions for now?
Just introductions for now.
Hi, I'm Stephen Costens. I'm an audit partner with SGC Accounting out of Houston, Texas. Our firm specializes in the automotive industry, and I'm looking forward to telling you some really horrid stuff.
I'm Tim Eady, a dealer based out of Minneapolis. We've got 43 locations in different places. Car Hop, I guess, is the name of the dealership. I'm in charge of implementing what he's going to tell you about.
David Fricky with Texas Capital Bank based out of Dallas, and we provide revolving lines of credit to consumer finance companies. So we provide leverage for either buy here, pay here companies or special finance who buy indirect to give them debt secured by the receivables on their balance sheet.
I'm John Donaldson. I'm the president of Glenview Finance. We finance contracts and basically act as a line of credit for dealers, both buy here, pay here, retail, and really let people grow where they may not have equity for traditional lines of credit. Historically, my background, I was in public accounting for about 10 years with Big Four firms, and just happy to be here.
Thank you so much. As we get started, Steve, can you give us the highlights of the credit law standard and the lease standards that are coming out?
So the two main rules that we had to talk about is CECL, which is the expected credit loss model, and then the new leasing rules. The expected credit loss standard basically says you must put a reserve on your balance sheet for all the expected losses in your portfolio, accounts receivable, contracts in transit, on the day that you make the sale. So the day you sell a buy here, pay here loan, you need to establish a, say, 25% reserve against that account if that's what you expect over the life of the loan that you will lose. The new leasing standard and it has nothing to do with lease here, pay here. It has to do with if you are the lessee on a lease, you must treat that lease as debt on your balance sheet. Because you have made a promise to pay someone for 5 years, that is now considered debt, and you have to record that debt on your financial statements. Now, you do get to book a corresponding asset because you have the right to use that piece of land for 5 years, so that is treated as an asset. But you are also adding debt to your financials for all the leases that you have signed.
Thank you. Does anyone have any questions about kind of the standards and what Steve just covered? Yes.
I presume the standard really applies when you're buying your pay that you put the reserve over your finance company, you sell a car, create the loan, and then the loan goes over to the finance company. That's where the discount is going to exemplify stated for the anticipated loss of the
So the buy here, pay here piece goes to the finance company?
Technically, in practice, yes. Technically, no. The second that loan was created, allowance, because the selling of the loan to your finance company is a separate transaction from the sale, initially that loan belongs to the dealership and technically would receive a reserve. However, if you transfer on the same day in practice, we wouldn't do anything about it. But if that loan spends any time on your dealership, it would require a reserve.
Any other questions? Let me bring the mic.
Thank you. As a follow-up to his question, so if you didn't have an RFC, are you still able to discount the note 25% or 30%, depending on your loss ratios for financial accounting?
It's not a discount, it's a reserve, and you would be required to do it, but it is not tax deductible. It is a purely for being conservative when you show your books to your banker.
Okay.
You've put a reserve against your losses, but you don't get any tax benefits.
Okay, so the tax law, this isn't a tax law change. Okay, thank you.
Any other questions? Okay.
Are there any size restrictions on the size portfolio, or is it for everybody?
It's for everybody. Even if you're not a buy here, pay here dealer and you just have regular accounts receivable, maybe from your service department, you are now required to book a expected loss on any kind of trade receivable, loan receivable, contracts in transit. Any sort of receivable must get a expected loss reserve put against it.
That's a great point. Can we talk for just a minute about how this changes a dealer's underlying business versus what the changes to the financials?
All right, so your financials, first of all, are going to change once this is ultimately implemented. Right now, there's actually a bipartisan bill that's going to delay implementation, and that's probably going to go through. We'll probably talk about that in a minute. But I would be quantifying it right now on a monthly basis so that you know, okay, here's what my financials are as I've been doing them for the past however many years, 5, 10, 30 years. And now you have your current expected loss and you say, okay, well, based on the way that I was reserving before, most people were reserving for, a year of losses, and then the rest of it would be made up with yield later on in the term. What this is saying is from day one, you're going to have to quantify what your losses are going to be on a principal balance, not that you get to, well, I'm going to have interest on these accounts later on and fees that can cover some of the losses. That goes out the window. So your expected loss on principal dollars, if it's a $10,000 receivable and 20% is going to be a loss rate on principal, which would be high, but if it was, then you're going to have an actual reserve of 20%. Now, if you were already reserved, so back to the question of how is it going to affect your financials, if you were already reserved at 15% before, once this implements, 5% is going to go into that reserve, and then the other 5% comes right out of your equity. That's how the adjustment is going to be made in the year of implementation.
Does it change the way they do business on a day-to-day operation?
I think it changes the way you do business if you don't have good data analytics to truly track your static pools properly, because you can't do this calculation without the data. So I would say definitely it changes the way you look at things and the way that you have to operate if you don't have that capability already.
Any questions about that?
I think there's a lot of dealers aren't aware of this at all. So what happens to those dealers that don't comply, because they just didn't know? I guess who enforces this?
So the first thing is this is GAAP finance accounting, so financial accounting. So if you have a credit line, if you've got a lender that is relying on GAAP statements, so they say you've got to produce financial statements. In the fine print, not so fine print of your financing agreement with whoever you're using or the security agreement, it's going to say your financials need to be produced in accordance with generally accepted accounting principles in the United States. And this is what that standard is. So that would be the first place that you need to comply. If you don't have that requirement, if you don't have to produce financial statements to anybody, then this may not even apply to you. You can theoretically do whatever accounting method you want. Now, when you get to tax, which this isn't a tax accounting breakout session, but the adjustment would be different. For, your accountant's still going to have to know what you're doing to get to that, to adjust it to tax, which would be the same regardless. So the answer is it might apply, it might not apply. Where it really comes into play is people who do have lines of credit and are producing financial statements on a regular basis. Maybe if some of you are big enough to securitize, you're going to have all of that. Right now, your statements, you should have a forward-looking statement as a footnote disclosure on your quarterlies and annuals saying that you're at least evaluating this for implementation in the future and cite the ASU 326. So that should already be in there. I mean, you're not going to get dinged if you're not, but I would say that's sort of the line of demarcation is really on the financial statements.
That's a great point. I'm coming to you. David, can you talk a little bit about what your bank is going to do when you start talking about compliance with this standard and loan covenants and all of those other things? We'll get your question.
Like everybody else, we're still evaluating what the impact's going to be and the timing and where it's going to come through. But, there's kind of like, I can answer on behalf of Texas Capital Bank and other banks that I think are positioned like us that have a fairly wide breadth of experience in lending to the industry, a lot of clients and some familiarity, so that we do a lot of work off balance sheet beyond what we get on the financial statements with regard to following static loss or loss to liquidation or collateral recovery rate in order to determine the question is, what are these receivables worth over time? What are the receivables going to collect for every dollar of principal balance that's put on the street? How much of that's going to get collected? How much of that's going to get charged off? So I think like us, any other lender who's already doing that, they have a pretty good idea of what your losses are. And they have an idea already of whether or not you are over or under reserved or adequately reserved, and whether or not your equity is overstated, understated, or properly stated. So this accounting changed on the one-time deal to make the difference. I would expect for us and for lenders in our shoes that this is going to be deemed as a non-cash event. Where it becomes more relevant is going to be going forward with regard to income statement recognition as the next loans you do. And if you're in a growth mode and you are continuing to add loans and growing pool of loans to your portfolio, the income you can recognize immediately is going to get diminished. So with regard to profitability covenants, those are going to be more difficult to meet in a growth mode. Now, again, I think lenders who kind of understand this and have been following and already tracking with their back office what the loss rate has been on the loans in which we're leveraging, that we kind of intuitively already know whether or not someone's income has historically been understated or overstated and built that into the covenants. And we'll probably adjust those now in order to bring everybody to reality. The flip side of that, though, is that if you are a smaller dealer or dealer doing business with a bank who really doesn't have that sort of back office and really is looking at lending just based upon the financial statements, particularly those who might be providing advance rates that, from our perspective, are relatively high due to the value of the loan, they might be lending based upon the fact that, well, this company has this much equity. And that when they get the financial statement, should that adjustment happen and they recognize that it needs to, and if they don't recognize it, the regulators very well might. And they suddenly see, well, I thought this company had X dollars of equity, and they really only have no equity because our advance rate, and then they start comparing the advance rate. It could cause banks that really don't have a large back office to suddenly say, well, wait a minute, this isn't the company I thought I was lending to. We were lending to you because we thought you were leveraged, one-to-one. It turns out you're leveraged infinitely, and therefore we're going to need to exit your loan.
David is right. This does affect your covenants and it does affect your equity. And so if your bank doesn't truly understand your business, it might make you look worse to them. So it's important that banks know your business, know your receivables, in order to not get freaked out when this rule gets implemented.
I don't want to be redundant here, but these rules apply if you have Corporation A, which is a sales company, and you hold that contract in there. But if you move that contract and sell it to your RFC, do you still have to put the reserve on your sales company side? We put a reserve on our finance company side in the RFC and the related finance company. Are you telling me we have to put a reserve on both sides?
No, the reserve will move with the loan.
Okay.
Effectively. If you sell the loans over right away to your RFC, no one will bother to set up the reserve on the dealership at all. But if you're holding the receivables for a period of time on the dealership, there will likely need to be some sort of reserve for the loans that while they sit there. But then once they move over, the
ours
reserve follows the
ours are moved almost at point of sale. So, thank you.
Anybody else? Tim, you do this every day. Can you talk a little bit about what you're doing and what you're seeing and how you're preparing for this?
So we've been probably compliant with the standard for a long time. I can't tell you, probably since early 2000s. Yeah. So the only thing I'll say, and I was confused at first a long time ago, that the discount was like, oh, we got a discount, and so that's the reserve, and they're related, but they're different. And the point is, your discount is a tax construct that you probably maximize to the extent that you can, and the loss rate inherent in your discount may or may not match what you have in reserve, plus your discount is amortizing as the customers make principal payments, whereas the reserve is truly, if I've got, $1 million of receivables, how much of that million do I anticipate I will collect, or really the reserve then end up being what won't I collect. So the concepts are similar, but they're not the same. And if, like in our case, we have most of our receivables in the finance company, we have a discount. You look at just standalone of the finance company, we've got a discount and an allowance that kind of magnify each other a little bit, and so that, in the case of if you didn't look at consolidated statements between the dealership and the finance company, it almost ends up being somewhat meaningless to look at the balance sheet of the finance company. So that, I guess, is one just clarification. I think, where it will have some impact is with ratios, obviously, depending on if you've got because if, the first time that you make the transition, you have to take a retained earning adjustment, which again is non-cash, so that's the good side of it, but you're going to have to explain it, and it factors into things like that. Practically how we implement it, and we've got a larger portfolio, we've got just under 30,000 accounts, and we have very detailed, specific static pools that we can generate. Whatever you might decide you wanted to know, if the car was red, what's the static pool on that, we can answer that question in a couple of minutes probably. So we've got a lot of data, but we set our reserve, and it's not overly complicated calculation, but we look at the credit quality, we pool it together, and so we break our credit risk of our originations into 10 different buckets, and each bucket has a different curve that it follows, if that makes sense. And so the best credit quality deals have a lower allowance rate for them than the poorer credit quality deals do, if that makes sense. And so the ones that we know we're going to lose more on because it was a shakier deal to begin with has a higher percentage of reserve. And so we take kind of that part of it, and then on top of that we layer in the how long that account's been on the books, because your reserve for your early deals that you sold or the most recently originated is going to be at a lot different percent than a mature note that you maybe had on the books for 25 months. The likelihood of that, the amount of that principal balance that's going to charge off on a percentage basis is significantly less, partly just because of the amortization of principal and interest, right? Every time you get a payment, you're knocking off a lot more of that principal than early on. It's mostly interest. So all that, and then the other thing you got to consider is changes if your deal structure changes. So if you adjust your down payment significantly, or the value of or the amount of the contract, or you change interest rates, all of those things are going to impact the likely collectability. And it ends up being a round number. And I go back probably not long after we had done this, I remember someone who was from the banking side of the world had suggested, you want to go back and look and see how accurately you did this in the past, because you won't get it right, and the reality is you're never going to get it right. I mean, you just can't. You may, right? But it's a really difficult. It seems easy, and in practice, And practically, especially depending on where your covenants are and things, it may not be that meaningful, but like in our case, we've been wrong where we've been over-reserved and we've been wrong because we're under-reserved. And the challenge, and I think the reason the standard hasn't been there forever, is it has a significant impact on your income statement. So if you're wrong by 1% or 2%, that doesn't seem like much, but if you take, you got a $10 million portfolio, 2% is a big number. And in our case, we've got a $180 million portfolio. 2% ends up being a pretty significant number, and it's to miss by 2% on this over the long haul probably is not unexpected with macro and that kind of thing. So I don't know if that helps.
I want to back up real quick because John mentioned how important data analytics were going to be when you start implementing this and talking to your banks and your financial partners. And if you ask Steve, Tim has one of the best methods in the business. So I really want to give you guys an opportunity to kind of pick their brains about what they're doing with static pools and their inventories and how they're measuring this stuff. Does anyone have any questions about that?
Sorry, Melanie, let me add something to this. So we missed the key part of this whole rule. This rule requires future-looking static pools. That's the change. The old rule was backwards-looking. So under the old rule, if you've historically lost 20%, you could reserve at 20%. The new rule doesn't say that. The new rule says it must be future-looking. So if your portfolio is trending worse or better than your older stuff, you must reserve worse or better. You must have a future trending methodology to your calculation, which is what Tim was alluding to. Tim looks at the credit quality of his portfolio, and if he has more A-grade paper, then he can trend his reserve lower because his portfolio is shifting to better paper, so he can reserve at a lower rate than he has historically. So he analyzes it by credit quality. There is no one method to analyze, but you must have a means of knowing if your portfolio is getting better or worse or trending better or worse, or if the portfolio is different. You've recently implemented dollar down payments. Well, that's going to affect your loss rates, and you can't just reserve at your historical loss rate because that will have an effect.
Thank you for clarifying. That's really important.
Yes, good morning, guys. And this question probably for Steve and David mostly. Putting aside the change that the first year we changed to this new rule, the adjustment that we're going to have to take, if we put this aside, do you think how many years after that will take to go back to normal where this adjustment is not impacting the financials? Do you think the next year or 2 years, how long does it take? And the second part of it is, if it's up to us, which one do you guys think is more accurate and reflect the truth health of the portfolio? Is it the old way or the new way? If we have it our way, just like to know what you guys think. Thank you.
Great question.
Okay, so, obviously I think the new way is more accurate. The old way, you weren't actually required to reserve for the whole life of the loan. So some dealers a lot of dealers under-reserve because you were not technically required to reserve for the whole life of the loan. The new rule is life of loan, so it is more accurate. I think it is mostly a one-time catch-up, and then once you've set that new reserve and the new calculation, you'll have the same sort of change year over year based on just the growth in your portfolio and that you've sort of had under the old method. The only difference is if things start to trend differently, you will have to adjust for the trends because you're future-looking. And if your portfolio is starting to head south, you're going to have to bump up that calculation and take a hit right there. And then as soon as you see the trends turning on you. But I think if your portfolio is stable, I think once you make the catch-up, it'll be fairly normal year over year.
David, did you have any comments? Put you on the spot.
In terms of historical versus future, which is the better method? The primary reason why, it's no mystery that most banks won't lend to buy here, pay here. They won't lend on subprime auto receivables, and there's only a few banks that actually have dedicated groups that specialize in doing it. And the reason is, part of it is because of a banker's narrow-mindedness that if you do something that we wouldn't do, then why would I lend to you? But the other part is because of bad history. and that almost every banker somewhere has lent money to a finance company and it didn't go well, and then bankers then are faced with two choices: either I'm not very smart as a banker, or you have a bad business, and self-ego always makes the banker go, it must be you and not me. And so, but the reason why those failures are frequent when banks get involved in lending and with too little knowledge to do so is that based on the current rules and the rules that have been in place historically, as buy here, pay here companies get a credit line, they do so for one reason: they want to grow. And then as they grow, they grow these lines of their line of credit usage, and they grow their portfolio, but often not reserving for the total of loan loss that they're going to take on that portfolio. So their static loss might end up being 35%, but they might only be reserving 15%. And that 20% gap between the 35 and 15, that's dropping down to income. So the dealer sees the income hitting the bottom line, the bank sees the income hitting the bottom line, they see building big equity, everybody's going to lunch, they think it's a great deal, and high-fiving the success and continuing to do it. But eventually there's a day of reckoning that comes, and then you have the correction that comes. So even if you didn't have this accounting, you would still have the correction that would eventually come, where the losses have to be accounted for in current day when they come. And that's when the bank's always going to say, because a bank can't tolerate a loan that's losing money, to say, I'm sorry, but I need you to pay me off. And then when you go out and try to find other financing, no other bank can do it either because of the loss. And often that company ends up failing, having to sell the receivables if the bank was advanced the right way to get their money back. So in terms of which is the better method, the correct method historically, I agree with Stephen. I think the new methodology is accurate. I think it's the one that actually shows where it is. And if you have a banker who truly knows what they're lending against, they're already aware of this. The problems come in terms of from a line of credit and financial statement user like us who are providing lines of credit and using that to determine where we are, is that a bank can't tolerate lending money to a company that's losing money. And they unfortunately can tolerate in the interim, while they think it's making money, lending that company too much money. And then when that day of reckoning comes and they can't get paid back, that's the difficulty. So to answer your question, I think that in terms of whether which is the better method, which is more accurate, I think that I agree with Stephen. I think this is the correct method, but there's going to be some adjustment and change to get there.
Thank you. Any other questions about that?
We've just started a finance company and a sales company. It's a division of a new car dealer group. We started our own sales company, and then we have an RFC. Is there any general rule when you don't have knowledge of specific losses? We've established 30%. What method do we use to come up with that? Kind of talking to industry people, and then, excuse me when I say this, and we did it a little bit by swag, and if anybody knows what swag is, so we, I guess my question is there in the buy here, pay here marginal credit finance business, is there a standard that, say, a Texas bank would look for a company to set up? Is it 25%, 30%, or what is that standard?
That is a great question. You are doing the right thing. You have to pick a number from somewhere, because you don't until you have some sort of data. The benchmarks this year show 27% as the net static pool loss rate. However, if you do an expensive car, I assure you can, I've got clients with expensive cars that have 15, 17% loss rates, and I've got clients with cheaper cars that have 35% loss rates. So you do have to try to adjust it a little bit for what kind of business model are you running. But probably you'd end up starting with some sort of industry average and tweaking it from there. And then as you start to build a bit of data, you would start to put it, weight it towards your own data until you have a full 3-year period and you know where these loans are heading.
For that very reason is why most banks won't do startups, because you just don't know yet what it's going to be, and it's a guess. But while you have an average, the variance and beta between what can happen is large. And rather than, try to dig in and re-underwrite the underwriting and make a guess, most banks, and ours included, are going to wait for at least 3 years of operation, so you have enough history in order to gauge to whether or not that was correct or not.
So what's an alternative for a company that doesn't have 3 years of history to operate in the meantime?
There are non-bank finance companies who feel confident enough that they can estimate the same way you're talking about estimating. They'll charge more, but they will provide financing at a center. Or you can go to a bank who is less focused on lending on the receivables that you're the loans that you're specifically trying to leverage in this case, and might look at the total wherewithal of the company or the guarantor support or real estate equity that you might have or other things, and provide that line of credit. But I think it's a good idea during that same to kind of keep in mind what your exit strategy from that's going to be, because sooner or later you'll run out of capital out of that source, whatever it is, or you'll want to escape and get to a position of cheaper cost of funds if you're with a non-bank finance, and you make sure that you're staying leveraged on an advance rate perspective that you can make that transition.
John?
So we are a non-bank finance company, and what we do to specifically address that question is we look to the actual quality of the individual account, and we make sure that we're advanced at an appropriate level. What we don't want to do is have such a high advance that if ever you do get to the point of, moving on to a credit line or whatever the case may be, that you just can't even get out of it because you're advanced so high. So we look to the specific performance of the actual collateral on a loan-by-loan basis. So it's a much heavier touch than a traditional line of credit. But that's typically what you would find from a lot of non-bank finance.
That's right. So there are non-bank lenders who will do startups, but they really hold your hand for those first 2 or 3 years, and they are in your DMS, they are in your financials. They calculate the borrowing base, not you, and they charge, in the teens for their money. But if you are careful with that money, you can grow to a point where you've got a bit of history and try to keep the leverage in the 50s, because if you borrow at 70%, there's no bank that's going to loan you that 70% once you leave them. So try to keep the debt, reasonable, so that once you've got a bit of history and you've made a little bit of money and you've got a bit of history, then you can move on to a more traditional bank and cut your interest rate in half.
Any other questions about that or something else? Okay, so what can a dealer do to prepare for, if you're sitting at the precipice of this standard coming out and you haven't started, where's a good place to start implementing? Tim, I don't know if you've done it or anybody?
The first thing, especially if you're larger, obviously if you're a startup, it's what we just talked about probably, but the first one is just to have probably a combination of decent data and the ability to generate static pool reports, because that'll inform you for sure. And I think and we have our own software, so I'm unfamiliar with some of the ones that are out there, but from going to 20 group meetings, people complain about the quality of the reporting in some cases of the DMSs that they use, and so having some confidence in the data and then using that to calculate, and given the significance of this change, and it's almost June or middle of June coming on July, if you haven't been talking to your friends like David, I think you need to do that soon so everybody's on the same page, because if you're going to have to amend bank agreements and calculations for covenants and things, you want to do that sooner rather than later. And I would get started on estimating the number and then just be using it as you go through the rest of this year, especially if you have 1231 financials that you do for, that are either if you have an audit, and even if not, that you probably share annual numbers that are calendar based. So you don't have a surprise in January, in December, early January when you're doing your numbers. But secondly, so you can adjust the methodology that you're trying to use. If you've got data problems, you can flush those out while you've got some time to make adjustments or to do corrections. So probably the biggest thing is do it sooner rather than later, and And hopefully your accountant hopefully should be able to provide guidance as well and some assistance.
Great. John,
sorry, I'll add to that. So
No, go ahead.
you're right. The DMS is key. You've got your charge-offs in your DMS. The reports might not be great, but if you can get your charge-off data out into Excel, you can start to build some static pools relatively easy. But you have to use your DMS correctly. That means when the guy charges off, don't give him, don't somehow stock the inventory back in for his balance and show no loss. That's not what happened. That car is worth wholesale value and you took a loss on that car. Don't, we see people putting retail values on the recovery, and we see people not doing the charge off and reselling the car and leaving the account open. And you have to have a dedicated charge off policy, charge the accounts off when they go bad, to generate the correct history so that we can later track and analyze what is happening and come up with static pool numbers.
Great. Garbage in, garbage out, right? John, I know you've been working with some of your dealerships to start seeing how this is going to affect their financials and working with them. What are you seeing and hearing from dealers who have kind of started this process?
I think a lot of the same questions just keep coming up. One theme that we've seen is people, a lot of the dealers don't have a good accounting firm, and one thing I've just been telling people is if you're talking to your own CPA firm to do some consulting work with you and help you on this and they haven't heard of this, go get another accountant. Just do it now, because this is one of the biggest pronouncements that's happened in GAAP accounting in probably 15, 20 years. And if they don't know about it, there's probably about 100 other things they don't know about. And they're probably costing you money in other areas because they're not paying attention. So I'd say make sure that you're surrounding yourself with really good professionals. SGC is represented here by Steve. So, there are good people that are here and here at this convention. I would reach out to them as a very good starting point. And then, the other themes that I see are people that are just, they don't have a command of their data. You can blame it on your DMS, you can blame it on your accounting, you can blame whoever you want, but at the end of the day, it's your responsibility. So, get it right, and if you don't like the DMS, get a new DMS, or go kick somebody, in the rear end to get it done, for whatever you need, and get a command of your data, because that's aside from GAAP accounting, tax accounting, a command of your data is only going to help you, because then you can actually make better operational decisions to prevent the losses, so you're not having to reserve so much on this model anyway. So that's what we've been telling people.
Just one other thing I'd add. So this isn't just a buy here, pay here, or a finance company rule. So, it applies, right, to, so if you think about like that lumber yard down the road from your house somewhere who's got builders that are customers, that lumberyard will have to do the same thing that we're talking about. And they may or may not have had that in the past. And so in terms of the local CPA who's unaware, makes it a little bit doubly scary if they've been unfamiliar, because they likely do have clients and other lines of business where that do carry receivables. The percentage is significantly smaller, of course, but the concept's the same.
Good point.
And from a pure business point of view, Tim, you actually test some different programs in different markets and then analyze the results before you implement across all your stores, correct? Because we've in the last couple of years had changes to pricing and deal structure things, and so makes it a little harder for us because we've got certain places where we originated with one deal structure, we've got another deal structure and others, and but we do tend, in the old days we just would go to a 20 group meeting and go home and decide to change something. Now we're a little bit more strategic about it because sometimes those things don't work out the way that you thought.
So I know, I think John mentioned that they were talking about maybe delaying the implementation, and FASB has been coming out with a ton of information recently trying to help with this transition and mitigate some of the effects. And one of the things that came out right before we came here was FASB allowing some assets to be considered just at fair market value. So do you think that this is helpful, especially to our dealers? And if so, why or why not?
I think it depends on maybe a point of view. I think fair market value calculation is a very different beast. What she's saying is there's actually an entire separate method of valuing your receivables that you could potentially elect onto if this all gets adopted, which would be a fair market value method instead of current expected credit loss. And fair market value has been around certainly internationally for a long time under international accounting standards. And I can tell you it's one of the most abused methods that you'll ever find. You know, even if you're saying, well, hey, a third-party sale, I have a bid here, and, you know, well, yeah, but what about, did you get 10 third-party sales? Did you, you know, how are you determining fair market value? And I think there are legitimate ways to do it, but I think you're right back into the same thing of, you know, you've got to understand the data. You have to, whoever the potential buyer is that you're getting a quote from, they would have to understand your portfolio, and you would have to be able to defend that, you know, on a go-forward basis, because it's going to change from year to year. And now, how do you have a consistency of method? And the biggest thing that the AICPA is trying to get to is consistency from company to company. You know, when you looked at the mortgage crisis, if you will, you had companies, I don't know if you remember them, some of the defunct ones that are out there, so I'll talk about them, like the Money Store. You know, the way that they were reserving for losses before First Union bought them over was vastly different from what First Union was doing. And, you know, that was a major issue right at the onset of what happened with mortgages. Well, you know, what they want, and this isn't to avoid some catastrophe, but it's to know that all of the companies are kind of cookie cutter. If we go to fair market value, I don't see how one company is going to be able to value from one company to the next at fair market value. I think you're going to have a vastly different calculation strategy.
Yeah, what we're talking about is you have the option to carry your paper not at principal minus the reserve, but carry your paper at the street value of the paper if you sold it. And the problem with that is when people bid on your paper, they always have recourse and they always cherry pick. And how do you ever truly establish what the street value of your paper is for the entire portfolio? And so I don't think anyone in buyer payer will elect it. It opens up a whole, at least a reserve we can calculate and come to a decision on. Everyone argues their paper's worth something different than what a company pays for it, or you know, no one can agree on what paper is truly worth.
Well, I'm sorry to interrupt, but further exacerbating the use of fair market value in this space is not only the beta and the variance between what comes, but when people are coming and buying a portfolio, you're talking about cherry picking. They're very rarely coming to you and going, and this is what I'll give you for your over 60 past due. But to the extent you have any over 30s or over 60s, they're going to pay different for currents, they're going to pay different for seasoning, they're going to pay different. So you can't say, well, I could sell a certain portion of my receivables for X price, and therefore that's the fair market value. It's going to be the hard part. It's going to be identifying what the bid's going to be for the part that they're not buying and maybe don't have any market value, because that arguably might be zero. And the other thing is, in terms of speaking as a user of financial statements and a line of credit provider, you know, if you're dealing with a line of credit provider who truly understands the business, analyzing it, if they see that your fair market value reserves are understated, there's a good chance that they're not going to accept those as saying, okay, that's okay. They're going to still do what we already do, and that is discount your equity as being overstated or discount your income as being overstated because of the fair market value application if they think the effective reserves are still inadequate.
I think that's great input. I just share this with you. I don't know if it's a good or bad story, but in our beginning, what we employed, it happens to be a business associate of mine, is a CPA that has buy here, pay here, and marginal credit finance experience, because we found just reaching out to CPAs is inadequate, because they don't have that specific knowledge base to help you. And then what I've done in the past, and what this dealer group is going to do now, as we build our portfolio, we're going to periodically shop it with the understanding to whoever is out there, We want them to give us what they think the value of the portfolio is, rather than us tell them what we think it is. We're going to have them tell us. And I've done that in the past, and certainly economic times will change that, that barometer. But if you take the proactive step, I think, to do that, you at least have some confidence that what you thought, and then based on what you're actually losing, is in fact, one, what people will buy at a price. It might be higher than what you thought. And or then if you've projected it out, you will know with a little bit more confidence. So then when you're talking to your main lender, you say, well, this is what we've done. We've studied this, we've shopped this, and this is not what we say about our portfolio. This is what they say about our portfolio.
Well, just be careful, because someone can say your paper's worth it, but they're not going to write you a check for it today. I mean, there's a big difference between, what someone thinks your paper's worth and are they actually prepared to write you a check for it. And we've had this issue with discount and the IRS, because discount is supposed to be based on what your paper would be bought by a third-party finance company. But if the person who gave you the bid that you set your discount rate off wasn't actually prepared or capable of buying the paper, the IRS has said that that's not a true bid then, because they weren't actually prepared or willing to write you that check tomorrow for the paper. So then the IRS has said that bid is useless.
I'd like to ask a question about the tax consequences here. My understanding is that, let's say a dealer or finance company is $500,000 you've got to move from your balance sheet, but that doesn't affect the profit loss. So then once that happens, your profits moving forward are taxed at a full rate, but you don't have the advantage of that, whatever the number is, 500,000 or whatever it is, loss. Is there a way to mitigate that, or am I mistaken on the way that's supposed to be handled?
This rule has no effect on taxes. Your tax guy actually has to undo the rule before he does your taxes. This rule has no tax consequence. You are not allowed to reserve for future losses on your tax return. So the first thing he does is take your financial and undo it before he begins the tax work. That's how it works.
Thank you for that.
Anybody else have questions?
Thank you. How do you guys see this being? There is few third-party static pool analysis out there. So how do you see the results? Now, do they have to agree with the CPA, with the banker now, and the dealer? So we got 4 different, probably, ways of, because they're not all, it's not a black and white. You guys agree with that? So static pools, you can get 2 different static pool analysis, and they probably have different approaches. So do you guys see any issues with being different opinions, the CPA to sign on the audit report, they have to agree with that, and also the lender has to agree with it too? And the second part to David probably is, how do you see that in relation with the CRR, with the future? Do you think the CRR is still as important, or you expect them that they should go in line with the static pool analysis?
I'm sorry, I apologize. I couldn't hear very clearly.
Do you still think CRRs are important if you're now doing static pools? And different accountants and analysts kind of have different static pool approaches and different, by make, model, down payment, different ways of looking at static pools.
Got it.
What if the bank disagrees or has a different way of looking at things?
I mean, we've always used collateral recovery rate, which basically, for those who are less familiar, is a ratio that's showing of every dollar of loan you put on the books, what percentage over time do you collect? The inverse being what percentage over time do you not collect or charge off, which would be the loss rate. So from our perspective, we think that the inverse of the CRR, which is if you have a CRR which says we collect 75% of every loan we make, and we charge off 25% of every loan we make. From our perspective, the 25% is the appropriate loss reserve of going forward of what you're going to collect. That is showing exactly what it is. Now, that's historic looking, though. So what you have to do also is integrate and make sure that what's happening with regard to your CRR, you have to not just look at it on a trailing 12-month basis, but you also have to look at what the trend of what it's doing over time. Because, if the average over the last 12 months is 70%, but most recently it's 65, then you're going to need to, think about those differentials and numbers in terms of how you reserve. And these reserves are not going to be static things. I think static pool from our perspective, is even more difficult from us as a lender to think about what your portfolio is worth, because you're looking at, well, what did the portfolio that you originated in 2009, how did that go? Well, I don't know what that means about the portfolio that you actually have on the books today. Different economic conditions, you might do different type of business, you might be in different markets, you have different people and different customers. So we still look at collateral recovery rate as our primary driver, because it's a cross-section of every pool that the dealer has on his books today. And every vintage that are on the books, not just one vintage from a static pool perspective. But we think that the CRR and the inverse to the CRR and what it indicates about loss rate is our best barometer about what future results are going to be based on historical results of what's been collected or charged off. So I think collateral recovery rate continues to will be for us our primary measure, and I think it really fits hand in glove with what the new CECL requirements are going to be.
Yeah, so I think they go hand in hand, because static pool honestly isn't accurate until you've got 18 months of data minimum under a portfolio. Well, the problem is a CRR is a much more current measure of how things are going. And so, so the static pool will tell you how you've done in the past, and the CRR can tell you how you're trending right now. And then together, I think you can marry them and get an idea of where you might need to set the reserve.
We have about 10 minutes left, and we touched a little bit on the lease standard when we started and kind of what that meant. And we've talked a lot about what this standard will do with loan covenants and things like that. Do you anticipate any other changes to banking relationships when you factor in the new lease standard changes as well?
Well, in terms of bank relationships with regard to lease standards, the question, in terms of if you have we don't, as a bank, leverage leases. But if you're talking about leases in terms of, there's two different aspects here. One are leases in terms of being, as opposed to loans. The same aspects are going to come into play with regard to leases or loans. It doesn't make any difference. There's no safe harbor outside of CECL with regard to that. But the other aspect with leases that's impacted, you guys mentioned earlier, is that things that were normally not shown in the book as assets and debt are now going to have to be shown as the book, because it reflects an obligation of the company as part of these rules as well. So in terms of a banker, how that impacts us is that that might deviate from the way the company's balance sheet has historically looked and mess with the leverage of debt to equity and how that looks. It probably it might have a differential of how things get accounted for in terms of expenses. I'm not sure. But just like the other, for the most part, though, that's going to be considered by us as a non-cash event. It doesn't really change the financial obligations or position of the company. And if your lender truly was understanding what your obligations were, they probably have already taken that into account. Again, to flip that, if you have a lender who truly doesn't understand what your obligations are, then you're going to need to get with them early and try to talk to them about what's forthcoming and kind of get their temperature about how they're going to react to seeing those changes suddenly in your balance sheet.
So the reason this rule came about is many companies, not necessarily small companies, but many larger companies intentionally do leases instead of buying in order to keep that off their books as debt. It makes their balance sheet look better, because a lease, you never record a lease as debt on your books. And so they intentionally lease equipment rather than purchase it solely to make the financials look better. So this new rule turns any lease into a type of debt on your balance sheet, so that you can no longer hide your leases off balance sheet. And so in turn, this will affect your, how much debt your company looks like it has. And as David said, I think if your bank knows who you are and understands you, they're not going to be worried about this. But if you're trying to go to a new bank and you just show them your financials and suddenly you've got $5 more million of debt on your books because you've got 5 leases for the next 10 years, it could, on the face of it, make your company look worse. Because there's suddenly more debt. Now, Tim, you got 50 leases? Property leases. How do you feel about this?
Hopefully I can delegate this to somebody. So it gets complex, and if you only got one lease, 2 leases, it'll be manageable. In our instance, we lease all the properties where we have dealerships plus an office, and so the calculations are all different. The duration of the leases are different. You've got to factor in if you anticipate renewing, what those renewal rates are, and the rent that you pay won't be what you reflect on your income statement. You'll reflect a pro rata lease expense for the whole duration of the lease, which, in our case, we've got some, like whatever CPI is, every 5 years adjusts the lease rate, but we're going to have to make guesstimates at some of that. So the calculation of it over a larger number of them is going to get complex and challenging to do with at least a simple Excel worksheet. And it will, I think from a dealership point of view, whether or not it has an impact depends on if you've got covenants that are debt to equity driven. So those are the kind of things that you'll have to think about.
Do you think that you'll list these 2 separate types of debt separately on your balance sheet, or are you going to roll it all up? Would it be helpful if you're talking to your banking partner or something to be able to show, like, this is my lease debt and this is the debt that I had prior to?
So the AICPA specifically defined this as not debt. It's a liability, but not debt. So you will keep it separate from your bank debt. It is a liability, but you will not roll it into your bank debt. You will just keep it as a separate liability, and it'll have dedicated footnotes explaining what it is and how all the calculations were made.
Thank you. We have about 4 minutes. Are there questions to address? Otherwise, could each of you kind of speak to? We've covered a lot of information. It's very, very technical. If we're going to walk out of here today and take information back to our accounting team, what are the biggest takeaways from here that they need to take back to their dealerships?
Well, I'm going to mention one other rule as my takeaway. There is a revenue recognition rule, and if you do a sale and you promise lifetime oil changes or you make promises as part of the sale, you actually must now split your sales price and allocate it to the lifetime oil changes, and which you will not be allowed to recognize until the lifetime that you promised. So if you get fancy with your deal structure and you give lifetime oil changes or include roadside assistance or whatever, you actually will have to split the sales price and allocate it to every promise you made as part of that sale, and do separate accounting for every one of the promises that were built into that sale. So, don't get too fancy with your deals, because it will mess up your accounting.
That's a whole hour in itself.
The biggest thing I'd suggest is get started. Don't wait. The sooner and I'd start with my accountant and understand that, and when you think you can or explain what it is that's going to change to the extent that you realize that it will change what you're doing, then when you go visit with your financing source, you'll be intelligent about it, and there's really no reason to wait. And come, if you're doing it at the end of the year and you got to produce financials, it'll slow you down for sure, and you could end up with a surprise, and surprises are never good. So.
I strongly echo what Tim just said. I mean, one obviously is be proactive. Don't wait for it to come to you, because otherwise it'll come to you worse. And so I would reach out to your CPA. Agree with what was said earlier. If your CPA doesn't know, doesn't understand, or doesn't seem very familiar with this, find a different CPA, or at least consult with a different CPA. And reach out to whoever it is that provides you capital, whether that's your shareholders or whether that's your investors or sub-debt or your senior lender. And make sure you're in conversation with what they know and do it. So, because surprises, particularly, not winning the lottery surprises, are never good. And then the other follow-up is data. You can't do any of this, and the truth is, you should be retaining and using data. And now the accounting is going to require that you retain and use data. And so, dealing with your DMS systems and those providers to extract what you need and then maintain and use what you need, even if you're not already using that in the operational decisions you're making in your business, data is going to be very important. So communicate and data.
So one of the things, earlier I said get a command of your data. Most, if not all of you, rely on some other people in your organizations to get you data, to be accurately recording that data. And so as a takeaway, I would say play a game with them, and I call it Stump the Chump. Because you're going to go back and you're going to say, hey, I just heard about all of this from these guys sitting on a stage, and are we ready to go? And, one answer that you might get, oh, yeah, we're great. Okay, good, show me. Show me how this is going to be different than what it is now, because we know it's not the same, right? So we know it's not what you're doing now. Show me how it's different. And just keep asking questions of your own staff, keep digging, keep getting get your professionals in line so that you're ready. And I don't think it has to be adversarial, but I think it is a very good exercise to make sure that you learn what you don't know, because it is different and it is new.
Thank you so much. Thank you, everybody, for joining us this morning. I hope you've enjoyed the NIADA and ABD convention. You've got a little more time left. Safe travels home when you leave here, and have a great day.